Welcome to this video today. What we're going to be doing is looking at George Soros and his techniques for trading and get some trading tips from him. And he is probably the most famous investment manager of all time, or one of the most famous for sure. And he was obviously in charge of the Quantum Fund, one of the most successful hedge funds of all time, which were responsible for the trade that broke the Bank of England, very famous trade, the billion-dollar trade. And basically, he's written a lot of material, and I think it's essential reading for any trader wanting to improve their trading strategy. And I think the most important theory that he came up with is reflexivity. And in that theory, he basically rejects the idea that all fundamentals are immediately discounted in the price, which is a basic pillar that most technicians believe in. And it's actually true if you think about it. Just because a fundamental bit of news comes out, it doesn't immediately get discounted by people. Those people can basically be acting on that fact later on. It'll also distort their view of the market. So it's really sentiment that is driving prices. And basically what the theory is really saying, or what I think it says, is that basically you can forget anything about markets being predictable. They're just not predictable because they're basically ruled by sentiment. So sentiment, if you're trading sentiment, is just an odds game. You'll see a lot of people who say that markets move to some hidden order, but it's not true. And all these computer programs that say so are basically lying. It's big industry on the net in prediction and seeing the future. It's impossible. And I think the theory of reflexivity gives you a basically deeper insight into how markets really move. Sure, you can use trend lines and technical indicators, but you are playing an odds game. What also I like about George Soros is that he rejects that complex theories are a great way to make money. As he said, the greater the complexity, the more room there is for error. And there is. People want to complicate trading. But if you make a trading system too complex, it'll have too many elements to break. You need a simple trading system. That's all you need. And then you need to just be able to execute it with basic discipline and confidence. And another thing that struck me about George Soros, which I found is really true, is when he basically said, if you find it investing entertaining or you're having fun, you're probably not making any money. Good investing is boring. And it is actually, because trading isn't about an adrenaline rush. If you start wanting to trade or getting excited, your emotions are involved. Trading is most of the time sitting around waiting. And then basically holding your discipline once those trades are in the market is actually quite boring to do, I think. But of course, it's the end result that we're all after, which is obviously making some forex profits. And George Soros, obviously he was in charge of one of the best performing funds ever. But he was also saying that at the end of the day, there's no shame in being wrong in the markets. And most traders do find it a shame to be wrong in the markets. They will fight taking losses. Their ego gets involved. They'll let losses run. And at the end of the day, you actually have to keep your losses small to survive long term. You get a big sort of hype on the net about you can win 80, 90% of your trades. George Soros never won 80 or 90% of his trades. Most good traders, or great traders even, only win about 50%. So, if you keep that fact in mind, you've got to keep those losses small in your trading strategy and run your winners. The other thing about George Soros, obviously he had a great mind, or has a great mind. But what he was always prepared to do was bet big when he saw the right opportunity. So, he wasn't into like a static bet size. If he saw something he really wanted to have a go at, he'd have a go, and he'd bet very big, like the trade against the Bank of England. Too many traders are caught up in the conventional wisdom of only risking 2%. It's conventional wisdom. I've said it in other videos. It's wrong. If you only risk 2%, as a small trader, you're never going to make a lot of money. Most of the great traders know that if you vary bet size, reducing it when you're doing badly, increasing it when you're doing well, or on trades that you really think are going to make a big gain, you will make more money. With George Soros, yeah, when you read his books, obviously he's got fantastic insight into the markets. But he's also, in many respects, a very simple trader. You know, he rejects complexity. He basically works on using a simple system and being contrary to the herd a lot of the time, and betting on the unexpected, as he calls it. If everyone is expecting something, then you want to be looking the other way. You don't want to be with the herd, and it takes very little to turn, let's say, a currency pair around when it's heavily bearish, okay, or heavily bullish. You can trade those turning points, and you can trade them for big profits. I would strongly recommend you go and read the Theory of Reflexivity, which I'm just about to say, and all the rest of the wisdom from George Soros, and try and incorporate some of his techniques and tips in your strategy. Thank you very much for watching me. Take care and have a good day.